Ladies and gentlemen, Tobin Smith here with Money Mavericks. We have our, what we like to call around our shop, the Mr. Macro with us today, Jay Hatfield. But before we talk about what the hell is going on every day in the economy right now, Jay, let's talk a little bit about the funds that you actually run and then how the macroeconomics here changing every day, or the what the F is the Fed going to do on Friday, or blah, blah, blah. But tell us how the macro affects your funds.
Well, we've been quite accurate in predicting the market, and you
Yes, you
really,
have.
not just the stock market, but the bond market too. And that is important because if you get that right, you're going to do well. So as you know, we predicted for like 4 months, so back to even April,
Yeah.
we would have a summer power rally. And boy, did we have a summer power rally.
Huh. But why did you think we were going to have a summer power rally?
Because the economy's quite solid. Tariffs, we believe, are good in the long run for capital formation and economic growth, because we're monetarists / supply siders, not Keynesians who believe everything's demand driven.
Right.
And if you look at the empirical evidence, it's massively weighted towards that supply side monetarist approach, which I can give you the data if anybody cares. But
yeah, I know. No, it's not a sleeping show. It's an investing show. Okay.
Exactly, right.
Okay.
But in any case, but the real catalyst was earnings, and earnings were really strong, particularly from tech. And so we had a real blowout. And, our targets, our conservative target's 6,600 on the S&P, and our upside target's 7,000. Well, let's stick to 6,600. Well, I'm looking at, we're at 64.
Yeah.
88. And so, and that's our year-end target, and it's only July or mid-August. So that's not so great. The fall's usually terrible. But what's true today that hasn't been true probably for the last 10 years, you had the biggest tech boom since the late 90s.
Yeah.
And for any of you younger people, the late 90s was a freaking great time to make money, okay? Particularly if you're an investment banker.
Yes.
And guess where I got most of my money?
Yeah.
So that's great. And so what happens is you typically get overvaluation. So we had a 22 multiple target, but it's really easy to get to 23, particularly with all this tech growth.
Sure.
But let's take the 6,600. So we're pretty fully valued at almost 22 times next year. So not even this year, next year. So that's a risk. Seasonality is a risk. AI is positive, and you normally don't get nearly a certain rate cut in September. Now, there's a lot of mealy-mouthed discussion coming from all the somewhat incompetent FOMC members. But if anybody is reasonable, which some of them are, well, clearly the Republicans aren't as focused on tariffs as the Democrats. I like Goolsby's a strong Democrat, but
yeah.
There's no doubt the labor market's weakening, so weak that the president fired the head of the BLS because he thought he was cheating, but it actually is weak, in our opinion. And
did you ever think you'd live to see a day where the president of the United States would fire the BLS chairman because he thought that he was being prejudiced against?
Yeah, shooting the messenger. But we were in favor of that because their shelter calculation is...
Oh, yeah, it's crazy.
It's absolutely a violation of fiduciary duty. But so inflation's really under control. We can get into that if it's relevant. But so rate cut, they'll probably do one. They'll do a hawkish cut because he doesn't want, there's going to be 3 Republicans. They don't think they want 3 dissents on the core Federal Reserve Board. So you just do one. It's really dumb not to do one because the fair value on Fed funds is 3 and we're at 4 3/8. So just do one and then wait. Why not do one?
Well, you make a great point. I love the hawkish cut, concept. Listen, I would put it in your words just a little simpler, that is it inflation or is it jobs that's going to drive this next cut? And it's jobs, you know it, everybody else knows it. And when that happens, for the Fed not to act, then the market says, "Wait a minute, how far do you have your head down in the sand?" So I'm totally with you there, brother. The jobs are weakening simply because of sort of normal stuff. Seasonality is part of it, but also, let's not kid ourselves. If all those great new production jobs, manufacturing jobs are not here yet, and in the real world, the service industries are getting a little slower. I was interested to see the little higher up scale restaurant chains, the Chipotles and the Cavas, et cetera, just
roll over, yeah.
roll over, yeah.
But
So that tells me that the top 25% does 80% of the buying. So it's the bottom 20% on the margin that is slowing down some of the service stuff. But why just 25 basis points? I mean, a quarter
Well, they
percent.
should do more, but they're incompetent. So we'll be lucky to get 25. But the critical data, so almost everyone blows this, but it's important. We have this on our
Yeah.
website. What causes slowdowns and recessions is investment, not consumption.
Yeah.
Because first investment goes down, then there's layoffs, and then consumption goes down a little bit. Consumers are like woodchucks who chuck wood, they consume. The low income has to.
Can I quote you on that, Jay? I have an interview a little later today. I just want to say that Jay Hatfield compared people to woodchucks.
So I don't even think woodchucks chuck wood, but consumers definitely consume.
Yeah.
Whether they like it or not, they'll consume a little less if they get laid off. But so all recessions come from investment. So 12 out of 13 housing, 1 out of 13 was tech in 2001.
Right.
But we're going to produce a chart on this. So construction and housing are in recession, so negative year over year investment. And tech, not surprisingly, which includes software and hardware, is strongly positive, and they're kind of neutralizing each other. So then you get slow growth, and you get slow industrial production because there's a lot of industrial production that goes into housing.
Sure.
Appliances, copper, materials. So you're seeing weakness in the old economy, but somewhat offset by the fact it's not just a tech boom like in 2001. Like that was all in like my hometown in the Bay Area. Just hired a bunch of software engineers and put up a bunch of ridiculous internet things. But here you're building.
Hey, I made a lot of money from some of those ones. Okay, so
definitely. But laying them off was easy, right? You just disperse everybody, and there was no traffic in the Bay Area. But now this boom isn't just like buying some computers and software and hiring some engineers. It's building data centers and power production. So there's a real economy impact that's never existed before. So those two factors are canceling each other out, and they're giving the Fed a pass on being too late, as the president says, or being behind the curve, as we say. And the reason they're behind the curve, they look at CPI. CPI is delayed by 2 years because of shelter. BLS is incompetent. Trump fired the BLS head for the wrong reason, but they are incompetent. Worse on shelter than even the housing, than the employment report. So, but the bottom line though is we are neutral on stocks. All we're saying is we counted the cards. We're playing blackjack in Vegas, and there's a lot of aces out of the deck. So it's kind of okay. So wouldn't like go all in here. So in terms of like our funds, like we would add to like BNDS and PFFA because we think rates are going lower, low vol.
Okay, and PFFA is what?
Our preferred stock fund, yields over time.
So when interest rates go down, the valuations of those preferred stocks go up.
And they also, even if long rates don't go down, if most investors think that there's going to be rate cuts, then they move from money markets into fixed income, and those funds do well. And
except what happened today? I was all ready to move about $5 million into my core sort of 10%ish, very low volatility type stuff, and do a little PFA just to kiss your ass. And then all of a sudden, at 640 interest rate, they've totally reversed themselves. I was confused.
Well, I do think that it's a risk that the Fed continues to blow it.
Yeah.
Because they do have a bunch of incompetent people that don't know economics, most notably the Fed chair, who's an attorney. So
Right.
their rates are going to be bouncing around. Like we think they'll be stuck around this 425 range right now, but
For
there
the
still
10
are
year.
two cuts priced in. As
For
long
the
as
10 year, correct?
yeah,
Yeah.
but as
Okay.
long as you get Fed funds rate cuts, fixed income should get flows and should trade pretty well. I think the 10-year might stall out until we get better visibility on the further cuts, because it's really driven by the terminal rate on Fed funds.
Right.
So about 100 over the terminal rate. Like terminal rate right now is 325. So not surprisingly, the 10 years at a little bit 425. I can look that up. I'm guessing that actually the terminal rate ticked up a little bit today. My
All
Bloomberg.
right. Explain terminal rate, Dr. Hatfield.
So that's like where the Fed funds rate is currently expected to bottom out at.
Okay.
Go out like 2 or 3 years. What is it at?
Of this business cycle, that would be the bottom of it because,
Right.
yeah, I'm with you. All right. So we have this little thing happen this morning. And then, we have jobs out. The futures are betting 98%. It was 98% this morning. Now it's 95% that we're going to get this 25 basis point. Do we have a chance for a surprise, given your dour outlook on the competency of the Fed funds officials?
I think we do. I mean, this whole notion of 50 was ridiculous because they're just not that good. But I think they'll do the
Note to
hawkish.
self: Jay will not be nominated for a Fed post.
Yeah. But I think that so 50s was always ridiculous. I never even entertained that. That's clearly off the table. It's still a chance they'll blow it, but I think this hawkish pause is the base case. I mean, hawkish cut, sorry.
Yeah.
And so they'll just be like, oh, we'll cut once, but we're going to wait and see tariffs and we don't like Trump and all this stuff. But so that's enough to support bonds and stocks, probably enough to keep this market, maybe it drifts down a little bit, maybe it drifts up, but it's kind of neutralish. But we just we like Amazon and Broadcom and Goldman Sachs and Morgan Stanley and KK, like those are all super high beta stocks. So if we're like wrong and we're not neutral, we're actually trending down and we go to 6,000, you're going to lose a lot of money in those stocks.
Huh.
So at the margin, adding something like you were saying, conservative, maybe interest rate sensitive, so PFFA, BNDS, but we on national television recommended like Philip Morris, Nextera, a REIT, KRC, so interest rate sensitive, more conservative. So those are probably what the margin I would be adding, because I think we're playing a little bit of musical chairs here, because nobody wants to sell in an up market. But if we start going down, a lot of people are going to be like, holy crap, like I added some at 5,000 and now we're at 6,500, like, literally like 3 months later, 4 months later. So like, why not take a little bit off the table? So we wouldn't be adding a ton. So we have 3 equity funds.
Okay.
We'll be fine, but it's just like adding, these riskier stocks, like their stocks are going to go down with the market. The fixed income should go down less or even up if rates are going down. So, or the Philip Morris's have no beta, like a almost negative beta. So being a little more defensive is not the worst idea in the world in the fall. But I'll admit, this market's a terrible short. Like PPI prints like some insane, it's overstated. We can get into that, but insane level. We're down like 10 S&P handles. Like, what's that? And now we closed flat. So
we are in a buy the dip market right now. Right. Maybe that's because of the $7.5 trillion on the sidelines. Maybe it's because there's a lot of money managers who are, not leading their statistics in their particular field. And so, I know as an old mutual fund manager, if you're like behind by the third quarter, then you sort of get your game on and get a little more risk oriented. What about, I mean, forget about the $7.5 trillion. What about the 44 stocks that are responsible for 93% of the S&P 500 gains? Does that bother you? Worry you?
Not really, because this AI boom is a real deal.
Yeah,
Like without it, we wouldn't have a 7,000 upside target. We would
yeah,
be like, holy crap, the market's way overvalued. So, and there's support pending, which is if the rates trend down or tech stumbles, then you'll get rotation because there's a ton of cheap stocks that aren't in those 44. Like the equal weight, I think, is 18 times this year, 16 times next.
yeah.
So if you want to bargain it, you can find tons of bargains. So that's also, it's both, you could cite it as a risk, but I'd actually cite it as a positive for support, because if this market is like today, I look at my screen over here to the left, and the S&P is up a little, but my screen's kind of mostly red with some green. But that's a pretty resilient market, because it means like instead of going down, it's rotating. So I think we're just going to roughly stall out here. If you want to plow into high beta stocks, you'll probably be okay, but that's just not our recommendation right
Yeah,
now.
I'm with you. Well, I mean, let's just call this the fourth industrial revolution. It's just started,
Yeah.
but we're not going back. The ROI, return on investment, on enterprise AI is starting to seep in. I'll just tell you, in the service industries, for sure, which
Right.
is softening the market. Again, Jay, I was thinking about when I was a low end analyst for Kidder Peabody in the 80s. Then they made me into a wholesaler because I could sell, and I wasn't that really good at the numbers they wanted me to do. But I mean, I would get some portfolio manager would come to me, give me all this paperwork, and say, okay, hey, smart guy, figure out which companies here are going to be growing their earning per share more than 15-20% over the next 12 months. I'd be great. I'll get back to you next month. I mean, now I speak into the freaking microphone and say, give me the top 20 stocks listed on the NASDAQ exchange, which have 3 consecutive quarters or more than 20% income yield, and that 90% of that goes to the bottom line.
Yeah. No, I mean, it's a real deal. So being conservative on targets is not a good idea. The rest of the street all lowered their targets. I mean, we're not really sell side, but the sell side lowered all their targets when we were at 5,000. That's just flat out idiotic. Okay. AI boom, pretty good economy, pro business. You may hate him, but pro business administration, lower taxes.
Yeah. Well, also M&A.
Right.
I mean, we're now, that M&A number. Could you imagine when you're at your club in the Hamptons, Jay, and you're hanging out with all your private equity buddies, and they're like saying, Jay, do you realize that we haven't taken any of our companies public in the last 4 years? And shockingly, the biggest trade in Wall Street now are the funds that buy the original private equity investors out of the fund,
Right.
so that
Well,
they can get some liquidity.
Big article in the Wall Street Journal about why Silicon Valley doesn't want to have Democrats anymore, because they need realizations.
Right.
They'll say, oh yeah, we'll pay higher taxes, but what they're really saying is you can charge the proletariat higher taxes, we'll keep our capital gains, but you better not screw around with our exits, because we make no money without exits. It's exactly what the Biden administration was doing, and they're not happy about it. But we've been recommending Morgan Stanley Goldman for on the Goldman side for 150 points. And it's absolutely working. They're in a flat out boom. So that stock's pretty fully valued, but if it comes in, it's just a huge buy. Just to hit on PPI quickly, looked absolutely horrible, 0.9, or expected 0.2. But you take out PPI is a very dirty, it's like a little bit like the employment report, pretty dirty data series.
Yeah, this is the producer's price index.
Right.
Okay.
And so X trade and food and energy, it was 0.6 versus 0.2 expected. But there's 2 ridiculous components that make absolutely no sense. Financial services inflation. So what the BLS does is if our AUM goes up because
assets under management, you're talking to civilians, sweetheart.
Right. So they went up whatever, 20% in the last month too. That's like we raised our fees 20%.
No,
Nobody's raising their money management fees.
It's a great point. I've never understood how you don't calibrate. It's not the fees you get is 100% relative to the assets under management. Your fees didn't increase. It's just your outcome because you had more assets under. I mean,
right, it's
insane.
like your clients are happy. So like they're not saying, they don't call you up and say, Tobin, the fund's up 40% and your fee's up 40. So what the hell is going on? They're like, oh, it's great. It's up 40%. So it's complete insanity. So you take that out. And then there's another category of government procurement services that was up like 3%. So which makes no sense whatsoever.
And what is government procurement service?
It's just like nothing. I mean, it's like whatever. It has nothing to do with real inflation. So take those two out and you're at 0.4, which is still pretty high, right?
Right.
This is 0.2 expected, but the prior month was 0. So it's a little bit like the GDP numbers, like, oh, we're up 3.5. Oh, that's fantastic. But we forget that the first month we were down 0.3. So that averages to like 1.5.
Right.
So you have to kind of average it. So, I mean, we need to watch PPI because that was, if the Fed had half a brain, they would have been watching that when they claimed that inflation was transitory. So you shouldn't completely ignore it. But you got to take out the government's nonsense because we've been saying this for 4 years, but the BLS is completely living in the 60s. Okay. They just never update anything. So you got to you got to analyze the data for what's real. Financial services inflation is not real. And in fact, we just calculated this like for this show, but we have PCE-R. So that's real-time inflation. So PC adjusted for shelter being at market, not the ridiculous way the BLS estimates, and taking out financial services. And it's 1.9% year over year. So below the Fed's target. That's core.
All right, J-Bo, I get that.
Yeah.
But the rest of the world, the other 900,000 to 999% of people look at the government data. So how does your insight into how effed up the actual, reported number is versus the actual number, how does that help you make people money?
Well, it's just that there are people who are rational on the Fed. So Waller, Michelle Bowman, now the third Trump employee appointee, Moran. I don't think that it's going to be as easy for Powell just to jam his Democratic Keynesian views. So these people are not completely stupid. Like everybody actually knows about this shelter problem.
Yeah, everyone.
They don't incorporate it in their views, which is just really, really
you would think that the real estate magnate president of the United States maybe would like just speak up and say, now that if you call Tobin Smith and ask him what his house would rent for, he has no freaking idea. He'll give you a number.
Just insane. But it is an issue with the president because he'll make an argument for cutting rates. It's not super intellectual.
Yeah, that's shocking.
That like, oh, it'll cut the budget deficit. Instead of saying, well, actually first of all, your target's completely arbitrary. You made up 2%, should be 2 to 3. Number two, your index is completely behind by 2 years and is really below your target already. And so just and the economy is weakening because construction and housing are weak. Like if he just kept saying that, I think we would have already had a rate cut because that's the argument for cutting rates.
I couldn't agree more, Jay. Again, I always want to nominate you to be the Fed chair. You would probably be assassinated. So, I mean, I don't want to see that. Okay.
I never have dreamed of being a government bureaucrat.
No, that was not your dream ever. I know that. But
that's why we.
Jay, here's what I'm trying to say. Yeah. So for the viewer at home, I think you've been dead right on the index numbers, where the market's going to be. What are the risks? In other words, when we get into historically bad time for stocks, September week, October usually, is the worst because the mutual funds are all trying to lock in their gains for the end of the year, blah blah blah. What are the things you're afraid of or would make you take less position? Now, I will say in our growth funds we are 80% long. In our income side, we're about 50% long. hoping that we were going to get a serious rate cut, which would then make these bonds go up. And you and I and other people have concluded that these guys have their heads so far up there. You know what? That we were going to get this 25 quarter 1%, which is basically nothing.
Right. I mean, it's more the signaling effect and getting that
Yeah,
long-term
I'm with
view.
you.
But so the problem with the fall is that you don't have earnings, right? So earnings season's over.
Yeah, you got that window of closed window.
Right. Yeah, and also when there's no buybacks towards the end of September.
Good point.
So you have a dearth of information, and good information comes from companies, and bad information comes from everything else, like the government, natural disasters, pandemics. So the
I love
problem
you.
is,
I love you, Jay. I just love you.
we kind of don't know till we know. So
Right.
what I was telling my guys today, like some traders like to be like, oh, I'm going to wait for a pullback. But like Steve Cohen and other great traders are like, I'm going to ride the wave until the wave crests. And then when it starts coming down, then I'll ride the wave down. And then when it bottoms up. So I don't really want to run for the exits until the music stops. And we'll know when the music stops when it stops. Today he said it's not stopping. Yet clearly bad news. Okay, you can massage it and do what I did and say it was only financial services and PC. Like the monthly PC number is going to be 0.35, which is pretty high core. But without that stupid financial services, 0.25, which is pretty under control. But that's a lot of massaging. So it could have been perfectly reasonable for the market to be down 100 S&P points. It's up 1.9. So that's
that's where I go back to the we have the behavior has been ingrained to buy the dip.
Right.
And you know what? It has worked. So at the basis level of human behavior, I'm going to keep doing what's working until you say it stops working.
If you're longer term focused, it's absolutely stupid to sell these AI stocks. Like they're probably going to become massively overvalued like Palantir, and you're massively going to print money. So who cares that it's going to be a little bit weak in the fall? Like, what does it matter?
Listen, I just got a new car. I call that car Palantir.
Yeah. I recommended it at 40. I didn't recommend it now, but
yeah,
I didn't recommend it from 160 to 200. But like Amazon's very cheap, was up a lot today. Like, why would you want to sell that? It's benefiting from AI, cost cutting. So I actually view the activity being rational, but we're just not willing to give bad advice and say, okay, this is the absolute time to go all in. It was.
April 12th.
I think on our call, one of your calls, we were pretty bullish. And now we're just like, yeah, we're bullish a little bit longer term, but let's try to be reasonable. I don't know what it's going to be, but I'll know when I know. Like if I wake up in the morning, the futures are down 70 handles, I'm going to be like, I'll take a little bit off. Like, why not be a little bit conservative, So, but on the converse, if every time there's bad news, the market's flat or up a little bit, like what's the rush to take all of your exposure off? Like, why?
Right. Well,
I would also trying to be reasonable, but if you're longer term, just forget about it.
Yeah.
Everything's great. The Fed will cut rates. It may be after Powell gets fired.
And that supports a base for stocks. That's why
so maybe we start cutting in May of next year. Well, that's a ways away, but it's still fine. We're going to get down to 3 and rates will be lower and stock prices will be higher. Like there really isn't a bear case other than just the unknown known, like the unknown. Like, China says this, Putin says that, Trump says this, people freak. But to your point, it seems like we're sort of over that. Like, oh, tariff this, tariff that. Nobody cares anymore. It's not driving the market.
Well, it was. No one had ever seen that, right since the Smoot-Hawley Act. That didn't go so well. It was the certainty of uncertainty that, as you know, does not really connote a strong a reason to buy stocks when you really have no idea.
Particularly think about the seasonality too, because in fact, probably our best call of the year, we're on with our clients in our webinar. And I said, well, next week's very likely to stabilize or rise because it's after April 3rd, 15th, where everybody's selling and earnings season is starting. And I got like 3 questions like, what the hell are you talking about? You actually think the market's going to stabilize? So it happened at the exact wrong moment where there was no earnings, no news flow. So what do? You freak out, market starts going down, and then everybody sells. So it's not surprising there was an overreaction, but now we're in a similar period where maybe a new problem and people will probably overreact to it. But if it's not pretty significant, there's going to be the dip buyers. And that's totally rational because it doesn't make sense for the market to come in hard in the fall. But it does, but it
Well,
doesn't.
it does for seasonal. Hey, look, here's the other one. I'm going back to my experience in 1998, 97, et cetera. These IPOs coming out and shooting up 200%, that's a little flashback for me to 1998. It's somewhat intermittent, but the window's open. Is that good for the stock market that the window's open for IPOs
Well,
and M&A?
I would say it's a good question because that's kind of like when the market gets overvalued, that's how it stabilizes, right? Because you generate an infinite supply. Like Bitcoin seems wonderful now, but if it keeps rising, there's going to be an infinite number of new coins that come out too. So it's a little bit of a sign, but we still have all these internet companies, like the AI companies.
Aging yourself.
Yeah, exactly. But these companies, they're all worth like $300-400 billion, not even close to being public.
Right.
So we're just in the beginning of the wave, and the ones that are being done are pretty small, and they're really liquid. So what's going to really potentially, stabilize the market or force it down is you get like a $300 billion IPO of a AI company, and there's like 10 billion of stock sold. The big gigantic ones.
Right.
Well, I think we're still early days, but it's something to watch because if we have an infinite amount of new supply, then that's going to be a problem.
Yeah, I mean, I always go back to the MicroStrategy in 1999 going into 2000, and on March 12th, I believe it was, they restated their earnings, and that was right near them. And then Microsoft, gave a downward cast about 2 weeks later, and that was the top, right? Well, but the difference, is that everybody at the top has trillions of dollars of cash on their balance sheet. And on March 12th of 2000, people had very little cash except what they keep going to the IPO market for to get more. It's a completely nonlinear comparison at this point. So
yeah, well, I would say that being older and living through the internet period, there was far more companies that had no legitimacy whatsoever.
Should never have gone.
Right. Whereas every company now has some revenue and has a real product and is producing savings for clients. So it's a much higher quality of IPOs.
Yes.
And
I have a stock certificate back here for Zoom.com, which I had helped go public and was able to sell those shares and buy another house. There was no reason on earth that a company making $12 million selling basically stolen clip art on CDs should have been gone public. Where there was this company called Bear Stearns that many of my friends that worked at, they were happy to take them public, Jay. I mean, the word bucket shop comes to mind. And we don't have that. That's what I'm saying. It's just no comparison. There's no Bear Stearns that would take as Zoom.com, this Figma that came out. People don't understand that when you do this IPO and you've gone to all your institutional investors and they've signed up, now the market makers have it. They have to short the stock to protect their positions. And then if somebody on Reddit or somebody on any of what I call now the attention economy market comes out and says something about Figma or something about the new Ethereum staking companies, of which we own, thankfully, then they're going to go like that. These guys got to cover their shorts, so now the price keeps going up, and then finally the shorts are all covered, and boom, a collapse. Well, we're not in that situation now. I'm totally with you on that, and so it's it's not even an apple and orange. It's not even an apple to a grape comparison.
But it is a good argument for buying the dips, at least on Goldman and Morgan Stanley, because they're going to print money on these IPOs and the mergers.
There's no question. I also say that Morgan Stanley guys told me that on that meltdown day, that was their biggest hedge fund margin call that they've had in a very long time, because everybody was so long, at least in the Morgan shop.
Yeah, I think that the retail investors saved us though, because they're not on margin.
Yes, exactly. Right. But they said, I said that was also reminiscent. These are guys like Brian Fuller, who's been there for a million years, and he said, yeah, Toby, it was very much like March of 2000. Everybody's super long, everybody's super jacked up. We got a president that's going to open up regulation and deregulation and so on and so forth, and then to get that, and then it was just the negative feedback loop that took it all down 25%. But how interesting was it that it came back 25% right after in 4 trading days?
Yeah, so I mean, not too surprising at least if you follow our research, because nothing really changed.
Right.
It's actually 2026 earnings estimates came in like a couple bucks. We ignored that. Now they're coming back. So if you're longer term focused, that's why I've said probably shouldn't stress out too much about whether we're neutral, slightly long, slightly short during this fall period, because if you're longer term oriented, it just doesn't matter. Yeah,
that's a great point. All right, so let's wind this up and say, how do people get on your e-letter to get your research, Mr. Hatfield?
So you go to www.infracapfunds.com.
InfraCap, spell that for us, please.
INFRACAP funds.com. Not a very catchy name, but and you can send us emails. We like talking to clients and prospective clients, so we're available for a dialogue as well. But we just did our webinar today. It's a good thing to sign up for. Even if you don't get on it, you can get the data that we put. And it's, there was a quote on Bloomberg from Deming, if you know who that is, like the father of modern manufacturing, that's something along the lines of a person without facts is just somebody with, a random opinion. So it's the facts that are critical, some of which I gave to you, not the opinions. So we put those facts out. You can come to your own opinions.
All right. Well, that's cool. Infracap.com?
Infracapfunds.com.
Funds.com. Okay. Yeah. Infracapfunds.com. Ladies and gentlemen, sign up. I've been a subscriber for a long time. Jay really has no strong opinions at all.
Love the Fed. Love the Fed too.
Yeah. And that's why we love him. And he's helped my firm and my wealth management clients do well. I tell you this story. I think I did, Jay. A guy was a long-term subscriber, finally said, all right, Toby, I don't want to do this anymore. Here's the money. And I said, well, okay, you've got $340,000 of AMSA that you paid $35,000 for. Shouldn't we shave that a little bit? He says, no, because that dividend I used to go play golf in Scotland every year, and it's exactly $24,000. So
that's not a bad way to look at it. It's not going down.
It's not going down. There's no less amount of gas compressors going to be needed in this country. All right, brother. Great to have you on.
Thanks for having me on, Tobin.
Ladies and gentlemen, Jay Hatfield, the one and the only. And we'll be back next week. And I'm telling you right now, do not panic here, guys. You really are buying the dip right now. It's going to work until it stops working. What makes it stop working is if we got to hideous, ridiculous valuations. And as a person who owned CoreWeave and was bragging about how much money I'd made on it, and then they didn't even miss earnings yesterday, but guided down a little bit, and then it came down 40%. I would tell you, ladies and gentlemen, that's a lesson for you. We didn't lose any money, but we didn't make any money on it. And when something gets frothy, you understand it's radioactive. It just depends on when the bomb's going to blow. All right, that's my advice for today. Great to see you guys.
Thanks.
See you next week.
great questions. Thank you for that.